Hi everyone, this is Finance Meets Real Estate. I'm Stefan Cvetkov. I have Reed Goossens here today. I'm really happy to have him. So if you guys know, he's the author of like 2 best-selling books. Let me just get the names of the 2 books. So the books there, so Investing in the US, The Ultimate Guide to US Real Estate, and 10,000 Miles to the American Dream, Our Story of Financial Freedom. So Reed manages, I'm sure the numbers fluctuate, but I believe like over 400 millions in assets under management. It's a multifamily syndicator. He's also a podcast host. His podcast is called Investing in the US, and he interviews real estate investors, business owners, CEOs, entrepreneurs, and go-getters who have successfully achieved financial freedom through investing here in the US. So Reed, his company is called Wildhorn Capital, and he's going to talk about his personal story, his coming to America story. So Reed, you're originally, where are you from originally? You're Dutch?
like you, mate. I've got a pretty weird accent. I'm originally from
You're
Australia.
Australian, right? Yeah.
Where are you from?
I'm Eastern European. I'm Bulgarian myself. Yeah, I came here at 22. So I just came here like for school. I went to work, pretty boring. and then I decided I want to be an entrepreneur, not work anymore.
Love it. Awesome stuff. Yeah, mate, thank you for having me on the show, and hello to everyone. And I guess we'll kick it off with my background. And for those people who are listening out there, I'm from Australia. I moved here, to New York, which I think is where you are, right, Stefan?
Yeah,
so
New York.
I moved to New York City in 2012, and the reason was to chase a girl, and she's now my wife, which is hooray! It all works out, the happy ending. And I was also really just to live a dream. I also came through New York in late 2009, as a backpacker, and I fell in love with the city. I was like, I've got to live here at some point, and subsequently, I fell in love with an American girl, which brought me back to the United States. And in 2012, we moved to the US, and I didn't have a job lined up at all. All I had was just a hope that I was going to get a job because we had a pretty awesome visa, Australians and the US, that if you have a sort of a white collar job, my background's in structural engineering. So I moved here without a job, but I had a structural engineering degree. If I could find a job, I could get a visa. And then from there, I was able to stay in the country. So I'm sure, like yourself, Stefan, you understand the issues of visas and work holiday, work permits and all that sort of stuff, and getting sponsored. And so, that's the stressful part. But
so you worked as a structural engineer at first, is that?
That's correct.
Okay,
yeah.
Cool.
So moved to the US in 2012. I didn't have it. I came as a tourist visa, and I remember I'd written on an A4 piece of paper all the engineering firms that I could find on Google in New York City. And I went around and I just started knocking on door to door until someone said yes. I got a lot of no's, but I finally found a small firm, actually also run by some expats, Russian expats. And I got the visa, right? I got the visa, I could stay. I got the apartment, spent a lot of money on an apartment broker. Apparently you have to pay a lot of money for those leasing brokers in New York City. And then I started to turn my attention to real estate, even though I got the job and I was working full time. But I always had this burning sensation to be in real estate. And I'd already been bitten by the bug of real estate prior to moving to the US. I actually had picked up the book Rich Dad Poor Dad in 2009 after traveling the world for a couple of years. And I was back in my corporate job in Australia as an engineer. And I was like, I've got more to give in life. And that more to give was like, what was that? And I had no idea what the word entrepreneur meant. I just knew that I wanted someone to pay me to live my life, to travel the world and surf awesome breaks, because I'm into surfing. But from that book started the obsession with real estate and learning and wanting to be a student of of what we do. And so when I moved to the United States, I'd already started educating myself in Australia. But then when I moved here, I found out that there's some a lot more access to information than it was back in my home country, probably also back where you're from in the Eastern European bloc. Moving to New York City, it was like taking information out of a fire hose when it comes to real estate. I remember attending my first real estate investment association meetup group, and just blown away that there was 200-300 people there all talking about real estate investing, all talking about financial freedom, about these different strategies to build wealth. And I was like, I'm hooked. I'm totally here. And then subsequently with that, I also noticed that there's these secondary and tertiary markets that you could pay $40,000, $50,000, $60,000 for a house. And in Australia, that just doesn't exist. So there's so many more opportunities to cash flow, so many more opportunities to build something from nothing. And it was just like my eyes were open. And I had a little bit of a, not a head start, but I had a bit more of a superpower because I was coming from a country where they didn't have awesome education. It didn't have the barriers to entry a lot higher. There's all these different things, but I was like, it sort of takes an outsider coming in to say, hey, look at what you got in your backyard and you got to go take it with both hands and run. So that was the start of it back in 2012. And we can go on, more into what I've built today in terms of scaling, and we can get into the nitty gritty of financing and stuff like that if you want.
That's really like, if I may interject, that's a pretty short time ago, that's not a long time ago. You've accomplished a lot, I feel, over just, 9 years?
Yeah, 9 years, 10. Well, yeah. God, don't age me.
Okay.
but yeah, so and then from there, so for your listeners, we talk a lot about different, you talk about financing and how to get involved in financing. I remember that from the get-go, like I was fresh off the boat. I had no credit. I didn't even know what a credit score was. So I had to buy my first property all cash. And through buying that property all cash with money I saved from my corporate job in Australia, I was able to get my foot in the door. And that helped me launch into, what I built today. And I always say to people when I get interviewed on different shows is like, you don't get to deal number 10 without doing deal number 1. And I don't care where you start, you have to get going at some point. And for me, I remember, learning some stuff in Australia, educating, coming to the United States, educating myself. And I got to that point where I had analysis paralysis and I just needed to go off and take action. And I could continue to spend money on more education, but I'd got to that analysis paralysis stage and I needed to go and jump in the deep end. Because I was never going to learn about operating a deal or buying a deal if I don't go off and do it. And so the big thing for me that I try and implore to people when they're listening to my story is like, you got to go take action. And if this, if some weird Australian can come halfway across the world and do this, then so can the average American. It's just about giving, through storytelling and telling, some of the lessons that I've learned. Hopefully some of your listeners today can take away some of those lessons and put them into action, which is really, really important. So you're on mute, my friend.
Yeah. So you bought you bought like your first house all cash, right? You didn't have credit at the time, so you started. That gave you kind of an entry into the field. And so how did it all progress until you got into multifamily syndications?
Yeah, so it progressed a few ways. I bought the first property then, which led me to my second little property. And then I flipped a house in Philadelphia, and I was doing all of this, like just off what I'd learned, going to real estate seminars and just giving it a go and saving up some money and then buying another property. I maybe had amassed $250,000 worth of real estate. It wasn't, it's still a lot of money, but it wasn't also that much. And I was getting to the point where I wasn't able to borrow much because I wasn't earning a lot being a structural engineer, in New York City. I was earning okay money, but not enough to like keep going, get loan after loan after loan. So I was definitely hitting a ceiling. And so through an actual really incredible meetup with a friend of mine at the end of 2013, I'm in a bar in New York City and we're sitting there. He's come down from Canada, he's Canadian. And I happen to, a good friend of mine, also an engineer. And I'm talking to him like, hey man, I've got like these 7 little units, and I'm earning $600 a month in cash flow. Like, look how good I'm crushing it, like thinking I was crushing it. And he goes on to tell me about, that he bought a 70 unit deal. And I said, 70 units, like 70? And he's like, yeah, 70 units. I said, how the hell did you do that? And he talked about other people's money. He talked about pooling money together with friends and family. He talked about getting a mentor to help him understand, to guide him through the process. And then the third thing he talked about was owner carryback financing. All the things that I'd read about in books and seen at seminars and heard about, but never actually seen. Here's a guy, a very good friend of mine, who's just upped the bar And I thought I was progressing along quite nicely. And then he's doing 70 units. And I said, well, if Scott can do it, why can't I do it? And that was that conversation then lit a bit of a fire, a bigger fire in my belly to go off and raise that ceiling, go and push the envelope. And so I went off and found a mentor. I found someone who I could, assimilate to, and it wasn't someone that had done hundreds of deals. It was actually, he'd only done one deal. But for me, the process of getting a mentor was actually more about learning to bet on myself. So, taking whatever money it cost me to pay him. And it was really the act of paying him was like, I am worthy of investing in myself. And that is so important to so many people. And people skip over that a lot, but I want to just, the mentality, the subconscious of that really helps you as an entrepreneur say that I'm worth it. I'm worthy of taking a bet on myself. Like you stepped away from your job. All entrepreneurs go through that mindset of, oh, am I going to do the right thing? Is this going to work out? There's always that second guessing. When you pay for something, you're like, okay, I'm going to take this seriously. And so from that, it wasn't like it was a silver bullet, but it helped me get my foot in the door. And through that, I was able to start my podcast called Investing in the US. And that's where I talked about basic things that I was learning, EIN numbers, getting credit, understanding how to get increase your credit without being fresh off the boat, talking to the international audience about the benefits of investing here. That was the original branding. And over the years, I've pivoted, but that podcast helped me tell my story because I thought if I'm going through these struggles, surely someone else is going through these struggles. And that's how the podcast started. And that's how I started getting, a bit of a following and starting to increase my database. And that's led to investors, and investors lead to wanting to invest in deals of mine. And so that was the start of it. That was in sort of 2014-ish area. And then, over the last 6 or 7 years, I've made some other cool pivots along the way that we can get into. But yeah, that was sort of the start of getting that mentor, starting the podcast, starting to talk about my story to other people in an educational way, like you're doing here on this platform. It was all about, trying to share the knowledge with others who want to be or want to start investing here in the United States.
Yeah, so a question from Nelson on the chat. So how are you raising capital from Australians to invest in the US, in case you are?
Look, so that was the original brand. It's not the most of my investors are Americans, actually. And it's not that it's, at the time, the Australian dollar was very, very on par with the American dollar. And so hence there was a lot of people bringing capital in the United States. But over time, I've actually, the majority, 99% of my investors are Americans. What that did in the beginning was help me put as a differentiator of what my brand was, right? I have a weird accent. I've got a story. Okay, well, let's talk to the international folk. But that's just pivoting in the beginning. Niching in the beginning. Once you grow a platform, you can pivot and you can be more broad with the way you approach it and the way you raise money. So right now, yeah, I've got a handful of investors in Australia, but the Australian dollar isn't very strong. And so you don't get a lot of people coming this way. And the majority of my investors are actually Americans. So it's funny how over time, over the last 6-7 years, it's pivoted away from that international branding where I first started.
And excuse me, Reed, this is Nelson right here. I'm the one with the
Nelson.
question. Hey there, Reed. And I just got your book, by the way. So
awesome.
And I'm working my way through it. And by the way, neither you nor Stefan have an accent. I don't know what you were talking about. There is no accent. Okay.
Nelson, you're kidding me. That's obvious for me here.
What do you sound like you sound like you're straight from Brooklyn. So Reed, when you started raising capital from Australians, was that a conscious decision you made to pivot, or did it happen gradual? Or, I mean, what was the deal?
Yeah, the decision in the beginning was about, so you heard the expression niche till it hurts.
Right.
In the beginning, it was, who am I? Okay. I open my mouth, I talk weird, right? And putting aside, your comment about accent, I talk weird. I've got a weird Australian accent. I'm learning about, I'm personally going through these, these lessons of getting EIN numbers and starting bank accounts as a foreigner and trying to build credit. And so I thought, well, other people who should be are surely going through these struggles.
Mm-hmm.
The story was about, the podcast started, if you listen to the first 10 episodes, it's all about really international investors, or understanding the investing lingo, getting your money into the country, starting a bank account, all these things that you need to get started. And that helped lay the foundation. Over time, what I realized was that in the beginning, I had a couple of investors who.
Read 1 second. There's some of us, if you could just mute yourself.
Yeah.
We've got some, Edgardo, if you could just mute yourself, please. Edgardo.
So I just, Nelson, you can unmute yourself now. I just had to mute everyone for that.
Okay, thank you, Edgardo. Thank you. So Reed, you were saying?
Yeah. So in the beginning, it was looking at who my audience was, right? What my special source, so to speak. And everyone has special source. Everyone's standing on a mountain of value. You just have to understand who you niche to, right? And so that just gave me the confidence once I started talking about something, once I started educating about a specific niche, then I started to branch off and pivot because, we're all entrepreneurs. We'll pivot all the time. I'm going to pivot when I'm 50 years old. I'm going to be, not that we're doing something different, but I'll be pivoting something else. And so in the beginning, you just start, you niche till it hurts. You find your place in the spectrum. And mine happened to be talking to international investors. But over the last 6 or 7 years, that's just really, I talk to, as most of my investors today are Americans, and I happen to have a tool in my tool belt that can help international folks if they want to, if they reach out to me, but it's not necessarily the forefront of the business anymore, if that makes sense.
Okay, so that's not the tool that you're using today. Now you're more with a domestic US investor.
and that's because I built a track record, right? In the beginning, you're just trying to grab at anything to be relevant and to help people with financial freedom, whether it's you pick up your phone. The majority of my people in my phone back in the day were Australians. So, okay, well, I'm going to talk to Australians about investing here in the United States because I was boots on the ground. Today, the majority of people in my phone are Americans. So yeah, that sort of, it's pivoted over the time.
So Reed, and first of all, thank you for that. 2 quick questions. One, what does your organization look like today? What does your team, your structure look like today? And my second question is when you were bringing over capital from overseas, could you talk through that process?
Yeah.
So I know it's like the 2 different sides questions.
So the first thing, the structure today is me and my 2 business partners. We very much have bootstrapped the portfolio. I think we brought on our first employee when we were 10 properties deep, which were that was 4 properties ago. So that was nearly over 2,000 units. So I was doing all the operations, the asset management, the underwriting. My business partner was sort of finding the deals, and he was sort of raising the capital, and we're just going off and making it happen. Obviously, we have a lot of strategic partners within the organization, i.e. our property management company, a general contractor. We don't own them, but we are very much aligned. And then the other thing we do, in the organization is we directly source materials from the Asian markets, flooring, granite, cabinets, all that sort of stuff to help streamline the process. And that comes from
the Asian, you said Asian markets, right?
The Asian markets, so from China and Taiwan, and that helps with the portfolio. When we're renovating units, I can really bring the price of renovations down because I'm buying at scale. And that's all based on my background as an engineer. When I was working, developing projects here in Los Angeles, I learned that, and I was able to bring it to my organization today. So we're still very, very, I think we have 5 people in we've got 3 full-time employees plus our 3 business partners. So there's
the role of the full-time employees, by the way?
Asset management, acquisitions, and we have an assistant who really helps with investor relations, and we have a part-time CFO. So really, if you're looking to start a business, first thing is probably CFO. I think the second thing, if you're not great at acquisitions or you don't understand how to underwrite, bring in someone who can. If you are good at that, you want someone who's more operational, bring in someone on that. Or you might be someone who's more who likes to build systems, and that's what you're good at. So really, the first couple of employees, you just need to set up what you don't like doing and hire for it. And then I've actually got this pretty cool little Gantt chart that I use that talks about the different elements of the business to help me define what I need to be doing most of and what I need to be doing least of, and who do I need to, replace me in that particular part of the business.
And can you share that Gantt chart later on?
Yeah, of course I can go through it, definitely.
And
then the second question you asked was the how to bring it into to America.
right.
So everyone, and again, I'm going to preface, I'm not a CPA, I'm not, tax, blah, 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 blah. Don't work with the IRS. But ultimately, as an international person, if you're taking on, as a domestic investor, if you take on international funds, you will be required to withhold tax from that international investor, right? And you can double check that. So the easiest way to get around that, if you want someone to invest with you, is get them to set up their own LLC here in the United States. An LLC can be set up by a foreigner. That's easy to do. Once they set up the LLC, they have the ITIN number. The hardest thing is actually getting the bank account set up. Once the bank account is set up, you can fund the bank account, and then they're treated like any of my other investors who use LLCs, and they invest directly into my deals. And thus I can give them a K1, and they need to handle all, their LLC tax reporting to the IRS on their own. I facilitate the introduction to good CPAs here in the United States, but ultimately they're like anyone else who owns an LLC. And most of my international investors are then set up to invest in anyone's deal, whether it be my deal, whether it be your deal, whether it be Stefan's deal. And that's the best way to do it. There's a bit of upfront work, a bit of upfront cost, but once you are set up and you're going to bring across multiple hundreds, maybe millions of dollars, it's definitely worth getting set up in the front end so you can go off and buy whatever you want to buy.
So Reed, so just like for our audience, just to clarify this part, so you're saying, like, let's say from, and it's kind of, I know like an attorney obviously can answer this best, but like from 506C, 506B, let's say capital raise, like with the SEC, let's say from an SEC perspective, you're saying for an international investor becomes, roughly speaking, identical to domestic investors as soon as he sets up an LLC in the US.
That's correct. Yep.
Are there any other actions they need to take to be considered, kind of equivalent and?
Well, it's the entity first, right? The entity's got to be formed, but again, the entity's got to only be there if you're going to want to protect something, right? So you got to be, you sort of have the vision to like, okay, I want to buy something or invest in something in the near future. That entity then helps, the documentation helps you go get an ITIN number, which is an international tax identification number, or an individual tax identification number. That then helps you go get a bank account. Then you can go get a foreign exchange to go into the bank account, and then you're all set up, ready to go. And then the third thing is making sure you're reporting to your tax, to the IRS every year, which is making sure you have a bookkeeper or CPA here in the United States handling your US functions. Now, I will say, please advise any of your international folks, they will need a tax accountant in their home country. I'm not an expert of what happens in their home country or how they're taxed or the tax treaty, but there will be both sides of the coin. So just be aware of that. So hopefully that answers the question.
Okay, that's awesome. That's a great answer. And let's say from an accreditation perspective, I don't know if you're in the UK or versus US and so forth, accreditation may differ a little bit, or like how does that work?
Look, the rule of thumb I just use is if they've set up a US entity, I'm treating the owners of that entity, whether they're foreign or domestic, as the same rules as accredited or versus non-accredited here in the United States. So
okay, got it. So
250,000 and $1 million or whatever it is. So
yes, so they would just go to, let's say, parallel markets or whatever and get accredited in the US. They would just go to the US accreditation.
Or if they're self-accredited, there's 5 or 6B, which you can just by signing away. I'm accredited. Okay, but now I will say, guys, the SEC is set up to protect American investors, right? American citizens, and there is another regulation, Regulation S for Sam, and I have never implemented that. But when you're raising money from foreigners, the SEC is not as concerned about. They're more concerned about your domestic individuals because it makes sense, right? They're set up by the US government. They're not set up to protect someone from England or someone from Australia. But go through. So the easiest way to avoid any rigmarole or any issues is just treat them the same as you would treat an American investor, which is the same.
So once it's a domestic entity, a domestic limited liability company, that's already treated, presumably in the same way. So makes sense. That's good. Thank you for clarifying that. And
Yeah.
Do you have
And-
other questions, Nelson? Yeah.
Yes, and again, Stefan, I want to say double and triple thank you for you for having. I mean, it's as if I think about like, hey, there's a book I got to read, and boom, Stefan has the guest. So, so it's a fantastic thing. And Reed, the reason I'm asking is because my background is I had a diplomatic status, worked overseas, lived overseas, military overseas, and now I'm having more and more people from these countries saying, hey. I like the U.S. security. I like the U.S. accountability. I like the U.S. dollar. So that's why I'm asking, because then I've already had people come and we've done deals in the U.S. But I am curious about this, and I'll be reaching out to you afterwards as well.
Yeah.
Double and triple thank you.
Look, as you get, if there's sort of, I'm telling you sort of entry level stuff, right? Like it's for someone who's bringing a couple of $100,000 over. They're going to keep the money here. They're going to use it as a bit of a retirement account. They don't want to take their money back and forth because they don't want exchange risk. But if you're going and raising $15-20 million from foreigners, like I can introduce you to right people who would have a better way to set it up rather than individually setting up all these entities. It would be more of a fund-based service. And again, just trying to start at the entry level. And if you're that advanced, well done. And I can introduce you to the right people who can help you set it up the correct way.
I'm not that advanced, but I like how you talk and think. Stefan, you're amazing. Thank you, Reed.
Thank you, Nelson. And actually, Reed, another question, because so your capital raise is like, you said you started with your podcast. And so is it predominantly retail investors, or do you have experience with, like taking in preferred equity and other, forms of capital on some of your deals? And how did that go? Like, what is your preferred kind of trade-off, control versus like, kind of keeping control versus, like having an easier capital raise, etc.
So I sort of talk about there's three different buckets. There's the retail bucket, which is where I cut my teeth and where a lot of people start, because it's your phone, it's your friends, it's your family that you're going to reach out to first. They're going to like and trust you in the beginning to give you some money because you're starting with zero experience, right? So when you're raising money, you need to have that rapport with them. They need to trust you before you're going to go out to strangers and talk about raising capital. So the retail investors, we typically do a 70-30 split on our entities. We go buy a 200-unit apartment building. And in that 70%, we split the equity up. So we'll say 25% of the equity will sit as what's called Class A. And then 75% of the equity will sit as Class B. One will sit, so Class A sits just after the debt, which is kind of looked as preferred. And then the Class B sits after the Class A, and then the GP sits beyond that, right? So if you're thinking in a visual and a capital stack type of scenario. But what that does is that the Class A investors, they get a nice, probably 9 to 10% preferred return paid out current, and they're sitting in a safer position, less leverage against them, but they get none of the backside, right? And then the Class B investors, they get whatever's left over in the cash flow. They get a preferred return, but it's accruing, but then they get 70% of the upside. And the reason we do that is as we were looking at more and more deals over the last couple of years, cash flow in multifamily has become tighter. Cap rates have gone down. And as cap rates go down, guess what also goes down? Cash flow. And as the delta between interest rates and cap rates compresses, meaning if you're buying a deal at 3 and 4 cap and you're getting interest rates at 3.5 cap, there's only 50 basis points to make cash flow, right? You need a good 100 basis point spread to really make some decent cash flow happen. So that's why we went to this model, this A/B structure, because as those cap rates were going down, as that spread was compressing, we found that we could do a financial engineering on the back end to say, okay, well, look, we can still offer this sort of preferred cash flow level of 20 and maximizing it out at 25%. Some people put their money in that, and some people put their money in Class B. And really what we found is everyone actually wants the upside. No one really cares about cash flow. Everyone cares about cash flow, but they say they care about cash flow, but everyone, once you sort of push comes to shove and you offer them both, that they really want the nut at the end of the day. Because a lot of my investors, a lot of the retail investors probably have a job, really well-paying job, and they, particularly the accredited investors, and they're looking to preserve capital over the long term and make it grow over the next 4 or 5 years, not necessarily worried about the 7 to 8%, preferred returns that they might be getting in the interim. That isn't, putting food on the table. Their sort of day job is. So yeah.
Let's say, Reed, and thank you for explaining that. But let's say for the Class A part, you have experience with taking that portion from, let's say, preferred equity kind of, wouldn't say institutional, but kind of mid-range capital providers.
I've done it once, and we have people who do it. The caveat you've got to look out for is the minimum repayment, which means, so in my retail example, if I choose to refi the deal and I've grown the value of the asset 25, the equivalent of the 25% of that equity, then I can replace everyone in Class A. And if it's 2 years in, they get a 1.2% on their money, and that's all they get. The preferred guys who are a little bit more, I don't want to say savvy, a bit more institutional, they may have a minimum requirement. They may say, okay, if you're going to cash me out in 3 years' time, within 3 years, well, I want a minimum 1.5 exit, right? And so that's, if you're paying a 10% pref every year and you're trying to exit them in year 3, well, really that's only going to get a 1.3 multiple on their money. They're going to require you to pay up the additional 0.2% or 20% to get them to their minimum requirements. I try and negotiate that away because I do want the flexibility should the value of my asset go up, which we've seen skyrocket in the last 12 months, and I go refi assets, I can replace their money. If they're at an 8% pref and I can go replace them with debt at 3%, well, that's cheaper, right? So why wouldn't I go do that? But I also want the flexibility that I'm not hemorrhaging the deal or hurting the deal because they're sitting in a preferred position and they have a minimum exit requirement.
Got it. That's clear. So that's kind of obviously, a loss of flexibility there as for exiting the deal. But have you had any control kind of issues with working with bigger capital providers or? Not
control. No, given that we started in the retail space, that's what I'm really familiar with. We have it's a great business model for both investors and sponsors in the retail space. We don't have to go down that path of, a friend of mine used to say to me, he's in the preferred equity stuff. He's like, come to me if you can never get the deal funded, because he's obviously, you're at the last hurdle. You're trying to get the deal funded. The terms aren't going to be the best. So just always remember to be raising capital. Always remember, if you're going to go do a deal, have your capital or a pathway towards filling the capital with retail investors if you can. First, going to these mezz pref equity guys is sort of I would put them at the back of the bus, so to speak. They're the last option. So,
yeah, makes sense.
And then the other thing we've done is we've done private equity. We've done a couple of private equity deals where just one check writer out of a big fund. They are in the more controlling seat, but they're providing everything, right? They're providing the whole stack, and we don't do 70-30 splits in those cases. We do sort of more 90-10s. Where we are signing on a loan with them, but we're sort of more as a partnership. And we've done 2 or 3, we've done it with 2 or 3 different private equity firms right now. It's an interesting model. It definitely a lot more, I don't say more work. I think it's more, what's the word? They are more sophisticated. So they require more hand-holding, right? They're probably in our business more than say $150,000 investors, if that makes sense, because the $150,000 investors trust us to do our job correctly, where the private equity is just like, oh, why are you doing that? Okay, you can't paint the building purple. No. when are we exiting? We also got to have it's more like a JV than it is, a GPLP, if that makes sense, because they have their LPs in their fund, and then their fund is investing into our LLC that's buying the deal. So it's really, from our point of view, as an operator, it acts more as a JV than anything else.
It's really just again, for our audience, what you call a private equity deal here is really, there's just no capital raised done on your side whatsoever. It's none. The whole capital stack is put from a fund where they capital raise it themselves. Mm-hmm. You come in together, you're sort of partner on the deal. It's, this quote unquote JV, call it. And that's how it works out. So what would be what makes it interesting to do a deal like that versus a typical like GPLP structure? And
I think that the thing that I've realized the most is the deals we've done with our private equity partners is we've done $70-80 million deals where I wouldn't be able to touch those types of deals with a syndication model. I couldn't go raise $20-25 million from 300 people. Like the syndication just tops out at a certain level. And you see a lot of syndicators today with the success that they're having, we're all having, they're rolling people's money into their own fund. So they're sort of creating their own private equity within their group because they're getting so much interest. They're like, okay, I need to pull the money together, put it into a fund, and then redeploy it into the deals that I'm finding. And I've seen a couple of my colleagues who I've, the last cut our teeth together have now progressed into that fund type of model themselves. So they are the private equity within internally. They're raising all that money instead of doing deal by deal. They're going out and saying, okay, we're launching a fund for $30 million. Who wants in? And they will raise that over the next 12 months. But as money comes in, they will then redeploy it to buy individual deals. And it still kind of acts like a syndication, but it has the word fund in front of it. If that makes sense. Mm-hmm.
Makes sense. And but you're saying the private equity partners, so they would want different terms, let's say, so their terms would be, you mentioned 90-10 splits?
90-10 splits typically. So you probably have a 7 to 8% pref on the front end, or to them, or to their fund. And then,
90-10 meaning 10% to yourself only.
So the first hurdle will be 7% pref straight to them. Between say 8 to 12, it might be 90-10. Between 12 and 15, it might be, you can negotiate maybe 80-20, and then 15 and above might be 70-30, or maybe it still be 80-20, depending on how many deals you've done. Obviously, the first deal you do with a private equity, you're probably not going to get much more than better than a 90-10. But as you do more deals, as you prove yourself to be more, you can go back to the well and renegotiate a little bit after you hit certain hurdles.
Got it. Okay. So another question we have. So how are you presenting these two options, Class A versus Class B, and the profile of these investors?
So when we first launched the Class A, Class B, it was a bit of a gamble because we didn't know how people would react. We thought people wanted cash flow and they wanted the best of both worlds, right? And so the best way we thought about offering it to our investors was saying, here's a smorgasbord. And really, it's just two options. You can put some of it in Class A, or you can put some of it in Class B. And depending on what you want with your money, we've got some investors who get their IRA money in the Class B, but they get their personal cash in the Class A, so they've got the cash flow. It just depends on how they structure it. And it was just through education, through explaining it like I'm explaining it here on this webinar tonight, through visuals, through investment decks. We just showed them how it would work. And again, we made everyone understand that they're capped. If you're in Class A, you're capped at a certain return. You're not going to get some of the backside. And people got it. They go, okay, that makes sense. I got the cash flow. I get to eat straight away, but I get none of the backside in 5 or 7 years' time. So they ultimately make the decision on where they want to place their money. And it was quite interesting that that a lot of people still want that upside on the back end.
So you mentioned there's a limit to, let's say, how much you can capital raise as part of syndication. Where would you say that is for most sponsors? I mean, for even yourself or other people you're seeing in the space?
Look, I think in general, if you're, put a gun to my head, I think I could go raise, 8 to 10. And then I may combine that with a couple of co-GPs who bring their own sort of investors into the deal, and we co-GP the deal. They might be bringing in 5. So I think around the $15 to $20 million mark is kind of where you're seeing it sort of as sponsors, maybe 1 or 2 sponsors coming together. That's what I'm typically seeing, because like anything, your investors only have so much cash. That's why you do these webinars. That's why I do the books. That's why I do the podcasts, is to try and attract more investors to put it into my database. So when I have a deal, I can get it funded. So again, I'm not going to go put a deal under contract if I'm not confident I can't raise it. And so if I need to go raise $30 million from my investors, I may be thinking differently if I'm going to raise $10 million from my investors, if that makes sense. So, yeah.
Is it, let's say, would you say it's is it common to do, let's say, half and half, or that's, I mean, because there's a control issue, but with the preferred equity, there's usually less of a control issue. There's more of, like, say, some of the flexibility on the exit side.
I see most people, most sponsors, including myself, filling the gap with other sponsors who may not necessarily be operators, but they have investors that they want to invest in deals, and it's a conduit, and they come and they partner with us in the GP. They're full on, they sign on the loan, they do everything, but they're bringing their own. They're bringing their own investors into the deal, and their investors are choosing A or B, and that's, you know, it's kind of like farming it out. But that's how it has a benefit for us as well, because if we say to our investors, well, oh, you're too slow, we've already filled it up, you know, even though we've met our allocation, but we've, you know, farmed out 2 or 3 other million, or, you know, maybe that's another 5 million to other people, then our investors will say, okay, well, I've got to act quicker next time. You know, it's like there's a psychological element to it as well that you have to understand. If I want to go do 4 or 5 deals in a year, I can't have all my investors blowing all their money on deal one. I've got to, like, keep some of it back so I know that more deals are coming through later throughout the year. Does that make sense?
Yeah, makes sense. And another question on the chat from Edgardo: are you dealing with any family offices?
Yes, we are. Yep. So family offices. So that was a third bucket that I was going to talk about. So there was there's retail, there's more the private equity bigger funds, which we're doing, and then there's the family offices, which kind of sit in between. And we've done 2 deals with 2 different families. Both of those families were smaller investors with us on our retail stuff. And they're both, you know, retail or family office, it's something they tested us. And thus, when they saw us perform, they're like, hey, we actually got some more money here. We're 1031 exchanging. Can you go find us a deal? We will, you know, it's just us, it's just our family money. And we're about to close on a $100 million deal with one of the families here in the next 2 weeks. But it started from them coming into the deal as a $50,000 or $100,000 investor and testing us a little bit, and then, you know, coming and having a longer conversation after we've proven ourselves. And so those family offices really act just like big retail investors. Most of them have their own successful businesses that they've run for many, many years, or it's family money or whatever it is. They don't want to go and do the hard work of finding deals and operating the deal. But they're going to be, you know, the 2 family offices we work with, we've got very good relationships with. We can pick up the phone, and it's with their family's money. So, like, of course, we're going to treat it really, really well, and they trust us and we trust them. So, yeah.
But do they get, like, some kind of preferential terms, or is it like any other LP?
They'll be like any other LP, but they do have control rights, and that's okay. They're better terms for us than a private equity, but not as attractive as a retail syndication deal, if that makes sense. Sort of sit somewhere in between. And so, you know, we had an investor who came to us who had a 1031 exchange. He had $7 million to place, and we went and found him a 106 unit deal in San Antonio, right? And he wanted certain types of, he didn't want to go above a certain type of leverage. He trusted us to, you know, execute the business plan, and he gave us a, you know, acquisition fee, and he's going to give us, you know, a cut after a certain preferred return. We also have a charge, you know, construction management fee. So as from our point of view, it was all the same type of looks and smells like a real retail deal. But it's just with one big check writer. And, you know, I call him once a month and we have a chat, and okay, great, my money's safe. Talk to you next month. So, yeah.
Perfect.
Just a quick question, Reed. With the relationship building in that family office, was it basically just hey, we'd like you to give us a shot. You know, we're raising $5 million, but you come in for 50,000, and we'll see how this goes. Could you just talk a little bit about that?
Yeah, look, a lot of people hear and get on my list or get on my partner's list through referrals, and usually we may get a sense that this person may have some more money to give. We people typically who introduce us, it's all about building that reputation, right? And reputation helps open doors to other folks. So in the beginning, our first deal, no, we had no family offices, you know, like, but on the second and third deal, as people started talking and saying, hey, you should check out Reed's deal or whatever, and I was introduced to people, I I knew sort of in the back of my mind that this person may have more money in the future. Not that I was trying to get it out of them, but just through performing well and knowing that my retail bucket is the bucket that I pull most of my money from. These other family offices that have come from there or private equity, that's icing on the cake. But making sure my retail investors, I'm reporting to them every month correctly. I'm giving transparency. I'm giving great updates. I'm doing what I'm saying I'm going to do. That's the most important thing, because then those people are your raving fans and they're going to go out and tell 10 other people. And that's when you start seeing these other little cherries and icing come down the track. Does that make sense?
Yeah. Okay. Thank you, Reed.
Yeah, and we're gonna move on to like kind of like the investment like deal side. I'm curious to ask you, but before that, like when you say private equity, so I assume you don't mean like Blackstone, right? They would be probably too big for that. So like what do you refer as private equity? Would it kind of like mid-range?
Yeah, like sort of
company. Just
I don't want to name any names because some of them have confidentiality risks. But there's some groups out of San Francisco and New York who raise from endowment funds. And they're long-term. Again, they are groups that don't necessarily want to be the expert in the market, but they want to partner with people who are experts in the market. They would rather go do 6 deals across 6 different markets because they're backed by these endowment funds who have long-term, protection, and they're really, really about capital preservation. And I will also preference that the private equity funds that we're talking about here have a more realistic return profile versus a retail investor. And that's the struggle you get over the years that I've been doing this since I started in 2012. Retail investors wanted 17, 18% IRRs, in existing multifamily. Now that return has been pushed down, but retail investors are always the last ones to sort of get it, where private equity people are more like, no, I know that the market's a 14 today. I don't expect any more than a 14. They're not trying to get 22% IRR returns or 30% IRR returns on existing value add multifamily. They know that they're being more realistic. So when you have more realistic return expectations, we can show them different types of deals. Well, unlike the retail investors, where I'm thinking about 1, how much I can raise, and 2, what's the return profile. And over the years, our retail investors have come hook or by crook, they're starting to readjust their return expectations. The 16, 17% IRRs to retail investors that we were doing probably 4 or 5 years ago is now a 12 to 14% IRR. But those private equity were already there 3 or 4 years ago. So it's a matter, they're just sort of keeping more of a realistic approach to certainty, to deal return expectations, if that makes sense.
Okay, yeah, that's a great point. And just on that, like, you mentioned like some of the kind of IRR expectations. So what would be, let's say, your perfect deal profile now? Like, what are you guys looking for at the moment, and like what kind of deal size and like
perfect deal profile, probably 200 to 300 units. Looking at probably. We don't look at 70s vintage anymore. It's just too old. That's done. But I still think with the right 70s deal, you can make it work. But we're looking at late 90s, early 2000s, and because that's now coming to be a value add. We're looking probably between 13 to 14% net to investors, to Class B investors, looking to probably double their money. It used to be 5 years on the projections. It's probably now more like 7 years, and the cash flow is probably somewhere between 4 to 5%, maybe 6% over a life of a 7-year hold. So that's kind of the return expectation would be ideal today. Anything lower than that on retail, it would be probably hard to sell. If you get into the 12s, that's probably more for a private equity, or a family office that just really has more capital preservation in mind, rather than trying to make a quick buck. And look, most of our retail deals, we only are in for 3 to 4 years anyway. So we're trying to, turn and burn and get people's money working for them again, and getting them to rinse and repeat.
When you say their cash flow is like 4 or 5% over the life, that you mean their pref or the preferred return, or what do you mean there?
No, I just mean the pure cash flow from the cash flow from the operations. So excluding the sale,
Okay.
you're just, year one, the cash flow might be 2%. Year two, it might be 3.4.
Sure.
Year four, it slowly goes up to those Class B investors.
Okay. And what are your preferred markets?
Like Central Texas, Austin and San Antonio is where we do most of our business. I like Dallas. I do like parts of Houston, but Houston's very large. But I like markets across the country. I think the fundamentals during this COVID, the relocation around the country, so many other great markets: Phoenix, Denver, the Carolinas. I like Charlotte, Greenville, Charleston. I like some of the Florida markets. There's a lot of markets I like out there. It's just trying to find the right market to be an expert in, as deals are coming harder and harder to find. Back in the day, I could probably look at 50 deals and find 2 or 3 that I really, really like in one market. Now I'm probably looking at 200 deals to find those 2 or 3 deals. So that might be over 3 or 4 markets that I need to look at. But really we're going, an inch wide and a mile deep in the Central Texas region. So we can be that expert.
Then in those, like the markets that you mentioned, they have like pretty high rent growth and, like overall price growth in like both residential and commercial space. So would you say like that some of the target IRRs you guys had over the years were maybe exceeded, or like how did it work between like realized IRR versus target IRR space in those years, your years of operation, given it's been a kind of a booming market over there, you can say?
Yeah, look, I'll be sitting here lying if I'm saying we're about to exit some deals and we're going to completely outpace our pro forma just because of what's happened post-COVID, right? This whole growth. But we're also buyers. So we're also looking at what does that mean for us? We used to buy stuff at 70, 80K a door. Now that's 150, 175K a door. Now, do I believe I can sell that thing for 200K a door, 250K a door in 5 years' time? So there's all these different conversations we're having. You got to back into, okay, well, what does that mean from a rent perspective? Well, I know when I first started looking at deals in Texas, the average 2-bedroom was about $800 for a 2-bedroom. 1 bedrooms are about $650. Today, well, coming out before COVID, they're about $1,000 for 1 bedrooms, or $900 to $1,000 for 2 bedrooms, $1,200 to $1,300. Now that's just increased 20% in the last 6 months. We're now seeing the average 1 bedroom around $1,200, the average 2-bedroom around $1,400 to $1,500. So, what does that mean growing over the next 5 years? Am I trying to push that to be $1,700, or I'm trying to push that to be $1,400, $1,500? And that's what we've got to keep looking at, is what does new product rent for? Do I believe in that story? Does that make me sleep well at night? And does that make me back into an exit price that I truly do believe in? And these are all the questions as you guys are listening to this call. As you looking at deals, you got to look at those fundamentals and say, do I believe in this rent growth over the next 4 or 5 years? If I compare to where I live here in Los Angeles, geez, even in 5 years' time, if a 1-bedroom got to $1,500, it's still really cheap compared to a 1-bedroom here in Los Angeles or San Francisco or New York. But I believe some of the markets I'm investing in will easily get there and still be affordable, quote unquote affordable. So, yeah. And
what is your approach to finding deals, agents or direct?
It's all through agents. The game is like anything. We're selling our first ever syndication deal that we bought 5.5 years ago. That deal was sold by that broker 3 times in the last 20 years. Who sold it to us sold it 3 times before we bought it, and is now selling it for us. He's selling that deal again. So he's sold it 4 times. That's the business. People, the brokers know the business. They know the owners. Look, I think if you're sub 100 units, you can definitely go more direct to owners in certain markets. But with how frothy it is today, all sophisticated owners are going through a broker because they're going to want to do a marketing process, a best and final process and all that sort of stuff, getting as many tours and eyes on the property as possible to make sure they're getting the best price. We're also looking at real-time data in our portfolio to help us make educated decisions, investment decisions for that next deal we buy, because we're a buyer as well. We're buying now at the 170 and 200K a door mark. And again, back to what I was saying before, I've got to believe in my rent growth story. Well, I can look at the current data in my portfolio to say, well, the lease trade out over the last 6 months has been 30%. I believe in buying this deal at 175K a door, because I know the in-place rents are so compressed compared to where my portfolio is. So having existing deals helps, but when as a new buyer, it also adds a little bit of pause when I'm trying to hunt for new deals, if that makes sense. And Nelson, I think you had a question.
Yes, Reed. I keep on wanting to call you Lou Reed, like the musician from New York.
Well, it's funny you say that, my friend, because my parents actually named me after Lou Reed. They loved him so much. They didn't like Lou, but they loved the name Reed.
Pure ESP. Deep down inside, I'm an Australian. So how are you using that real-time data you were saying?
So the real-time data, let's talk about it for a second. So when I'm looking at a rent roll on a current deal, we just bought a deal the other day. It's a deal that I looked at 3 years ago, and they're selling it 3 years later. They've done nothing to it, nothing whatsoever. And it's now $8 million more than what we were going to pay for it back in the day. Back in the day, those rents were $800 effective in place. Mm-hmm. Today, they're $1,000 effective in place. Well, I've got 500 units down the street that the average effective rent we're signing new leases at is at $1,300. So when I'm seeing that one of the comps, I know the history of the deal, which makes a lot of sense. But when I see that a direct comp to this current deal is a deal I already own, and they're $300 less, which is 30% less on an average effective basis, then I'm like, that's a no-brainer. Of course I'm going to go buy that deal, because I know I already know the operations. I've got efficiencies in scale because I have an operating partner who's already there. And I just know what rents are going for, because I can see what I'm signing the rents just down the street at for newly renovated product. That helps me a lot. And that helps a lot of other operators in other markets. If you look at when people sell deals in markets, they double down in the same market because they just know it so well. They're just like, I just sold it at this price, but I'm looking at this deal down the road. And just to my point, rents are compressed 30%. I'm going to use the money I just sold that deal to buy that one because I know you just start to know your market so much better. And real estate is really a local, it's a local sport. So you've got to understand what's happening and what's growing. Right.
Locally. Okay. Reed, thank you.
Thanks, Reed. You've been really generous here with your time, and it's been extremely useful, I think, to our audience. The last question I would say that we have on the chat is if you do any new developments by any chance, or is it primarily stabilized?
So my background's in real estate development. One of the stories I didn't get into, but for a lot of people on the show, when I moved from New York to Los Angeles, I mentioned earlier I was a structural engineer. I had a visa problems. I had to still be employed. So what I did was I used my engineering background to get a job with a developer here in Los Angeles. And I was able to, I worked with them for over 4.5 years, building ground up product here in the LA area. But I used that skill set to make that pivot. So I was always surrounded by real estate 24/7. I say that just because there's probably people listening who are saying, well, how can I get more involved in real estate? Maybe there's a skill set you can go get a corporate job in the space. But back to your question, real estate development, think of it like the food triangle, right? The good foods are on the bottom. That's all your cash flowing existing deals that you want to shove as much stuff into that as possible. Multifamily, storage, industrial, anything that spits off cash flow, that's, putting lipstick on a pig, chuck that into the bottom layer. The middle layer is a little bit more like fixing and flipping. The top is actually real estate development. It has the highest risk, but the highest reward. You have to know what you're doing. It is not as simple as, I'm just going to go sign a contract with a GC and I'm off. I spent 4.5 years as an owner's rep, literally going to war with the GC to build 300 units in Long Beach. And there's entitlement risk. There's housing commission risk. There's coastal commission risk. There's construction risk. There's financing risk. And that's all before you've even got the deal, a shovel in the ground. And that can take time. So back to the question is, yes, I do have experience in it. I will look to do development in the future, probably in the not too distant future. with prices going the way they are. But just understand it's a whole different league. And you really, really need to understand it from all the things I just mentioned, entitlements and construction and scheduling and financing, to make sure you nail it. Because if you don't nail it, you can bleed. And I've been in situations with my former employer where they were bleeding, and it's not pretty. There's blood everywhere. So.
Okay, so that's been great. So Reid, what is the best way that people can reach you?
There's the last question. There's someone from, who's that from? It's sexy. It is the sexiest and it is the riskiest, but don't get me wrong, in markets like today, and I'll just add one last thing before I leave, I am looking at deals where, so back to what I was talking about, $150,000, $200,000 a door. Well, I've got to sell that. I know the 50% rule. I've got to increase the value of that asset by 50% to get a mid-teen IRR to my investors over a 5-year hold. So what does that mean? If I'm buying at $100K a door, I need to sell it for $150K a door, and that will give me a 15% IRR to my investors. If I'm buying at $200K a door, I'm going to sell it for $300K a door in 5 years' time. The thing is, that is, sorry, someone.
Just one more. If you can unmute.
There we go. So again, if I'm buying at $200K a door and selling at $300K a door, I'm now approaching new development costs, because roughly, depending on where you're building, it's probably going to cost you $250K a door, including dirt. Now, again, there's all the risks involved with it. So there is that academic approach that, as I look at existing deals, do I believe you're starting to butt up against the cost of replacement? But in saying that, cost of replacement is also going up. So it's an interesting space where we are in the cycle right now. And a lot of people are turning to development because they'd rather take the risk and spend the $250 a door on the dirt and the building, then go out and buy an existing thing for $250 and hope it makes to $350 in 4 or 5 years' time. That was just for a high level point of view. Back to your original question, where can people reach me? Head over to reedgoossens.com. That's reedgoossens.com. If you're ever coming through Los Angeles, you want to say g'day, you want to go for a beer or coffee, just hit me up at info@reedgoossens.com. Would love to meet up and talk shop. And I'd love meeting up with other investors and sharing a bit of knowledge wherever I can.
That was great. Thank you so much, Reid. Really appreciate it. Thanks to everyone for joining us here today.
Thanks, guys. Awesome questions, by the way. Love to meet you all.
Hey, Reid, and just to let you know, I'll be reaching out to you, okay?
Yep, and I'll put this in the chat so everyone can see it. There we go, www.reedgoossens.com. Yeah, Nelson, reach out to me, mate. No worries. Have a great evening, everyone, and thank you so much.
Thank you.
Reid, thank you very much. And Stefan, thank you very much.
Thank you, Nelson.
Be well, guys.
Bye.